Have you ever wondered how banks create money out of thin air? The money you see in your account doesn't actually exist in the way you've always believed. And this is not an exaggeration, nor is it a conspiracy theory. If tomorrow all customers rushed to the banks to withdraw cash, the entire system would collapse within hours. Because the truth is that money does not fully exist as people assume. This isn't some random flaw, nor a system error. This is exactly how the entire financial system was designed from the very beginning. A mechanism that has existed so long, so deeply rooted, that we gradually see it as a natural part of life. This mechanism is called the fractional reserve system. It is the silent machine behind global debt, inflation, and the illusion of wealth. When you truly understand how it works, you'll realize that money is built on promises that almost never can be fully kept. To understand where this story begins, we have to go back to a time when the world didn't operate on flashing numbers in banking apps. Like today, back in medieval Europe, gold and silver were money. If you were wealthy, you stored metal coins in chests or owned jewelry to use in trade. But carrying heavy bags of gold everywhere was extremely dangerous. So people began depositing their valuables with goldsmiths, who owned extremely secure vaults. In return, goldsmiths issued paper receipts, promising that as long as you brought the receipt back, you could withdraw your gold anytime. It didn't take long for people to realize they could use these receipts to trade instead of the gold. The paper still fully represented the gold's value, but it was lighter and easier to carry. And from here, the first trick began. Goldsmiths soon realized something. Almost no one withdrew all their gold at once. If they had 100 depositors, only 1 or 2 showed up each day. That meant most of the gold just sat in the vault, untouched. So, the goldsmiths came up with a more cunning idea. They issued more receipts than the amount of gold they actually held. If the vault contained just 1,000 gold coins, they could still print 2,000 receipts, without anyone knowing. The extra receipts were then loaned out for interest, meaning they were earning money off gold that didn't even exist. As long as people didn't withdraw gold all at once, no one would notice anything. Simply put, money was being created out of thin air, and this wasn't just a side hustle. It was revolutionary. Once people accepted paper receipts as equal to real gold, money escaped the limits of physical matter. From this mechanism, banks were born, turning this trick into an official part of the financial system. By the 17th century, even governments adopted this model. In 1694, the Bank of England was created not to serve the people, as many assume, but to solve an urgent problem. The king was drowning in debt. After endless wars, the bank lent the government a sum far larger than the gold it actually held. In return, it received steady interest payments. That debt was not repaid with war loot or new revenue from conquests, but with taxes from ordinary English citizens. Sound familiar? Because that is exactly how modern governments still operate. They borrow money that, in reality, does not fully exist, then use taxes from future generations to pay for that debt. The United States followed the same path. Early American banks issued paper money redeemable for real gold. But they soon realized they could print more money than the gold they actually held. Mass withdrawals happened in waves, exposing the illusion. Panicked depositors rushed to reclaim their money, only to find it wasn't really there. Many banks collapsed overnight. Yet instead of abolishing the system, governments strengthened it. They created central banks to back the system. The message was clear. Even if the money doesn't truly exist, we will ensure people always believe that it does. Now, let's interpret this in today's terms. Because fractional reserve banking sounds simple, but it's as abstract as smoke. Imagine you walk into a bank and deposit hand. You think that money is sitting safely in your account, ready for you to withdraw anytime. But in reality, the bank is only required to keep a tiny fraction of that deposit. In the past, this could be 10%, meaning the bank kept just $10 and lent out the remaining $90. Someone might borrow that $90 to shop, and the seller would then deposit it into another bank. The second bank keeps $9 and lends out $81. That money gets deposited again, loaned again, and the cycle continues. By the time the cycle ends, your original $100 has multiplied into nearly $1,000 circulating in the economy. But here's the important truth. Only the first $10 is actual physical money. Everything else is debt, created through lending. Every new dollar in the system is born from someone's obligation to repay debt. If this surprises you, in fact, this is already an old story. In the United States today, the required reserve ratio is no longer 10%. It is 0. Since March 2020, the Federal Reserve no longer requires banks to hold back any portion of customer deposits. This means the familiar money multiplier mechanism is no longer what determines how much banks can lend. In Vietnam, the mechanism works differently. The state bank still maintains a required reserve ratio, typically around 3%, for short-term deposits in local currency. So if banks are no longer constrained by the amount of reserves, what stops them from lending infinitely? The constraint today no longer lies in reserves, but in regulations on capital adequacy and liquidity. These regulations were established under a global framework known as Basel. The Basel rules were created after a series of crises, especially after 2008, by a group of regulators and governors from central banks who met in the city of Basel, Switzerland. It is also the headquarters of the Bank for International Settlements, often described as the central bank of central banks. These rules are not issued by congresses or parliaments, but created by unelected technocrats. Here is how they work. Banks must prove they have enough equity to absorb potential losses that may occur. These rules are quite complex, but imagine it simply like this. If a bank wants to issue a risky loan worth $100, they may be required to hold $8 of their own capital as a safety buffer. This is the real limit on lending. The more risky assets a bank holds, the more capital it must maintain. Additionally, they must also prove they have enough liquid assets to survive a short-term crisis. These assets include cash, government bonds, and instruments that can be sold quickly if needed. These rules were designed to keep banks from drifting too close to danger. But notice what has changed. Today, banks no longer take customer deposits and then lend them out like before. They create the loan first, and that very loan creates the deposit. When you borrow money for a house, the bank does not take cash from a vault to hand to you. They simply enter the amount into your account. This new money exists because you have promised to repay it in the future. Only after that does the bank check whether it has enough capital to bear the risk of that loan. That is why, in the modern system, over 90% of the money in circulation is not central bank money, like cash or reserves, but money created by commercial banks out of nothing the moment they issue a loan. Think about that. When you look at the balance in your checking account, remember that it is not the same kind of money as the money created by the central bank. It is money created by commercial banks, and its very nature is debt. Therefore, the amount of money in the economy keeps expanding as long as banks can find borrowers. And that is why every financial crisis is essentially a crisis of confidence. Because if borrowers cannot repay, or banks cannot roll over their debts, the entire system begins to falter. This design leads to three inevitable outcomes. First, inflation. When banks continuously multiply the same base money to create more and more credit, the value of each unit falls. Prices rise not only because of supply and demand, but because the currency itself is diluted. Second, perpetual indebtedness. Because money is created only through loans, there is always more debt than money to repay it. In the system, interest ensures the balance sheet never closes. Someone, somewhere must default, refinance or borrow even more. Third, concentration of power. Banks earn profit from money they never truly owned. Governments rely on this mechanism to fund wars, welfare, and bailouts without raising taxes directly. And the wealthy, those who hold real assets, stock, real estate, or commodities, benefit when inflation pushes asset prices up while ordinary workers see their wages lose value. When this machine breaks, the entire illusion collapses. Look at the Great Depression in the US in 1929. Banks had lent far beyond their reserve capacity, contributing to an inflated stock bubble. When panic erupted, depositors rushed to withdraw, but the money simply did not exist in full. Thousands of banks collapsed in a short time. The same thing happened in 2008. Banks multiplied mortgage-backed securities, creating a housing bubble, built on the same old principles. Created a housing bubble based on old principles, more promises than the reality available. As defaults spread, the entire system nearly collapsed. And once again, governments and central banks had to intervene, injecting trillions of dollars into the system to maintain that illusion. They saved the very mechanism, because if it collapsed, the modern economy could no longer function. And this is when the global picture becomes important. In the United States, the required reserve ratio has disappeared. In Europe, the UK, Canada, and Australia. Reserve rules have long been mostly symbolic, or almost non-existent. These countries now rely entirely on the Basel rules. Meanwhile, in emerging economies like China, India or Brazil, required reserves are still maintained, often at double-digit levels. This is the tool they use to control credit growth speed. But even in those countries, Basel capital regulations remain the highest layer of control, determining how much risk banks are allowed to take. Regardless of where you live, the binding chain of money creation no longer lies in the cash held in vaults, but in the rules written in Basel, Switzerland. And here is the hard truth. This system cannot function if you have absolutely no debt. If tomorrow every household paid off all their loans, the money supply would collapse. Banks would have nothing left to lend, and the economy would come to a near standstill. This entire illusion exists because of you. Because you continue borrowing, continue spending, and believe that the numbers in your bank account are real and sustainable. You are both the fuel and the collateral of the system. That is why history becomes important. The mechanism medieval goldsmiths once used to generate profit has been magnified into the foundation of modern finance, and the risks from the past remain intact to this day. The bank runs of the 19th century, the Great Depression in the 20th century, and the global financial crisis of the 21st century all remind us of one thing. Once trust begins to crack, the entire house of cards collapses. Yet time after time, the system reacts the same way. They keep everything going, patching up the breaking illusion and behaving as if nothing serious happened. And now, the question you truly need to ask yourself is, what do you take away from all of this? First, money is not real wealth. Wealth is not the numbers flickering on a screen. Real wealth is land, the resources you control, the skills and knowledge you accumulate, the ability to be self-reliant. These are the values that stand firm, even when all promises on paper become meaningless. Second, debt is not neutral. It is the lifeblood feeding a system designed to favor lenders, governments, and asset holders. And while they benefit, the burden quietly falls on your shoulders. Third, inflation is not an accident or an unexpected event. It is baked into the structure of the system from the moment it was created, and every year, you must run faster just to stay in place. This does not mean the future is doomed. Not entirely. But it does mean you must seriously reconsider your relationship with money, because keeping cash in a bank account cannot protect you from the system's volatility. Blind trust in the system will not free you from it. Only when you build real wealth yourself, values that can stand outside the cycle of inflation and debt, can you reach financial freedom. The lesson here is not to spread fear, but to wake you up. If the money you use is born from someone else's debt, then your freedom begins only when you step out of that machine. And to do that, you must start with small, practical steps you can take now. Build yourself an emergency fund, so unexpected events don't push you into debt, and hold assets that can retain value over time, instead of relying only on savings that inflation slowly erodes each day. Invest in your own skills, because knowledge grows faster than money. And don't forget to diversify your assets, so no institution or crisis can dictate your future. History does not repeat exactly, but it always echoes familiar patterns, from medieval European goldsmiths to the bank panics of the 19th century, or the 2008 housing bubble. All are different versions of the same story, a trick that multiplies promises far beyond reality and a crowd that believes until that belief can no longer be sustained. And don't mistake this, the story isn't over. Every major financial crisis in modern history reminds us of one thing. The stability of the system is not based on goal or productivity, but on trust. And trust is the easiest thing to lose. Therefore, the next time you look at your account balance, remember that most of it exists only on paper. It was created by a debt-based system that was never designed to bring you freedom. Once you understand this mechanism, you can finally begin to protect yourself. But if you ignore it, you remain just a player in a game where the house always wins. If this changes the way you see money, don't keep it to yourself. Share this video with those who need to understand the system they are living in. And don't forget to subscribe to Prosperity Pathways. That helps you protect your assets, your choices, and your future.